Welcome to Tech Money Madness, your daily U.S. stock market deep dive. It is July 2026. And I want you to imagine walking into your favorite local restaurant right at peak dinner time.
Okay, I'm picturing it.
So the dining room looks completely packed, right?
Yeah.
Every single chair is filled, the energy is buzzing, but then you look a little closer and realize management actually roped off half the building.
Oh, because the kitchen staff and the servers just vanished.
Exactly. The restaurant is technically full, but the capacity has secretly been slashed in half. And that illusion is exactly what just happened to the American economy today.
It really is. We are looking at a market right now where good news is being brutally punished, bad news is being completely ignored, and, massive waves of capital are flowing into some incredibly unexpected sectors.
Yeah, it was a highly mixed day. The Nasdaq slipped today. Tech stocks are giving everyone whiplash. But our mission for this deep dive isn't just to, read you the ticker tape. We need to connect the dots.
Right, because there's a fascinating puzzle here.
Exactly. We're going to untangle how a historically weird jobs report directly triggered a bloodbath in the EV sector. Plus, why big tech is suddenly terrified of the physical world, and how massive gas stations and autonomous drones are quietly becoming the safest bets on Wall Street.
And to understand any of these stock movements today, we really have to start by diagnosing the underlying engine of the economy itself.
The workforce.
Exactly. The American workforce is flashing some very complicated warning signs. And that macroeconomic uncertainty, well, it's the invisible hand driving every strange market reaction we're going to talk about today.
So let's look at that engine. Our sources show the U.S. job creation numbers are cooling off at a pretty rapid pace. We are looking at just 57,000 new payrolls added in June.
Which, for anyone outside of institutional finance, 57,000 jobs might still sound like a positive number.
Right. It's still technically growth.
It is, but in the grand scheme of an economy the size of the United States, that represents a severe, sudden sluggishness in hiring momentum. Meanwhile, the headline unemployment rate is sitting at 4.2%.
And a 4.2% unemployment rate historically signals a relatively stable, functioning economy, right? It doesn't sound apocalyptic.
It doesn't. But that single number is masking a much deeper structural crack in the foundation, which brings us back to your restaurant analogy.
Yeah, this is the stat from our briefing that really made me stop in my tracks.
Yeah.
The labor force participation rate just fell to its lowest point in 50 years.
And that is entirely excluding the massive artificial drop we saw during the COVID era.
Right. We are back to 1970s levels of workforce engagement. I need to understand the mechanics here. How can unemployment be a totally normal 4.2% while the participation rate is at a half-century low?
Well, the secret lies in how the government actually calculates unemployment. The headline unemployment rate only counts individuals who do not have a job and are actively looking for one.
So they have to be submitting resumes, taking interviews, that sort of thing.
Precisely. If you get frustrated and give up, or if you decide to retire early, or say childcare costs force you to stay home, you drop out of that calculation entirely. You are no longer considered unemployed. You simply vanish from the workforce data.
Wow, so you were the tables that got closed off in the restaurant.
Exactly. The labor force participation rate measures the total potential capacity of the economy. It's the percentage of all working-age adults who are either working or trying to work. And that capacity is shrinking dramatically.
So it's older workers accelerating retirements, maybe younger generations struggling to integrate into traditional corporate structures.
Yeah, because of the gig economy. And structural costs like childcare making it economically unviable for dual-income households to maintain two careers. People are literally just opting out of the traditional economy.
And how is Wall Street translating that sociological shift into financial panic?
Well, when the labor pool shrinks this drastically, it creates a very fragile environment for corporate growth. Companies cannot expand their operations if they physically cannot find the workers to staff them.
Which caps their future revenue.
Right. Furthermore, a shrinking workforce means fewer everyday consumers with disposable income. This data point is the skeleton key for today's market. It explains why we are seeing a massive rotation of capital away from large-cap growth stocks.
And large-cap growth stocks being those massive household name companies that are valued based on the assumption that they will grow exponentially every single year.
Yes. Those companies need a booming, expansive economy with infinite labor and confident consumers to justify their astronomical stock prices. When the labor force shrinks, that growth narrative just collapses.
So institutional investors are taking their money out of those risky growth bets and retreating to the safety of value stocks.
Exactly. Companies that are valued simply because they generate reliable, steady cash flow right now, regardless of the broader economy.
So investors are pulling their ships into the harbor because they can see the economic engine is running out of fuel. And if the labor pool is shrinking and the average consumer is looking at this highly uncertain landscape, I mean, it makes complete sense that they aren't rushing out to buy a $60,000 luxury item.
Oh, absolutely.
Which brings us perfectly to the absolute chaos we're seeing in the electric vehicle sector today.
The EV sector is undergoing a brutal real-time stress test of consumer demand.
Let's talk about the Tesla paradox, because this is where the market reactions just look completely broken. Tesla was one of the most active stocks on the board today, but it was also one of the top losers.
Yeah, the stock tanked 7%, marking its worst single day in nearly a year.
But I'm looking at the data from our sources, and they actually hit their delivery targets. They sold the cars. Okay, let's unpack this. Why on earth does Wall Street punish a company with its worst day in a year for doing exactly what it's supposed to do?
Because in today's market, Wall Street doesn't just grade a company on whether they are winning today's game. They are relentlessly scrutinizing how much cash the company is burning just to stay on the field.
So selling a high volume of vehicles is only impressive if you maintain your profitability.
Exactly. What Tesla is experiencing is severe margin compression.
Margin compression meaning it costs them roughly the same amount to manufacture the battery and build the car, but they have to sell it for significantly less money.
Which squeezes the actual profit they take home, yes. To keep moving that inventory in a high-anxiety economy, Tesla has been forced to slash prices and offer massive incentives.
Right. So investors are looking at those delivery numbers and realizing that the revenue might be there, but the profit margins are evaporating.
The stock price isn't a reward for past deliveries, it's a bet on future profitability. And right now, Wall Street is betting that the cost of selling an EV is getting way too high.
And to really understand how wild this sector is right now, we have to look at the rest of the players, because everyone is getting hit differently. Our briefing notes that Ford's Q2 sales actually dropped 10.3%.
Ford represents the legacy automaker struggle. The data shows their drop was partly due to a physical supplier issue with their F-Series trucks, which is, their cash cow.
But fundamentally, they're also getting slammed by falling EV demand.
Right. They tried to pivot to electric, and the consumer just isn't following them at the expected pace. Then you look at Lucid, which is what we call a pure-play EV startup.
Pure play meaning they only make electric vehicles. So if EV demand dries up, they don't have a profitable gas-powered SUV division to fall back on to pay the bills.
And the risk of that model is really showing. Lucid entirely missed Wall Street's expectations for the second quarter. So you have a legacy giant in Ford and a luxury startup in Lucid, both hitting a massive wall of consumer hesitation.
But then, just to throw a wrench into everything, Rivian is having a great day. Our sources say Rivian actually managed to raise their 2026 delivery outlook amidst all of this doom and gloom.
Which is fascinating. Rivian's ability to raise their outlook proves that the EV market is no longer a rising tide lifting all boats. The initial blind hype phase of electric vehicles is completely dead.
So we're now in a brutal reshuffling phase where companies are fighting a zero-sum cage match for market share.
Exactly. Wall Street is ruthlessly punishing any sign of margin compression, like with Tesla, or weak demand, like with Ford and Lucid.
And that fear of cost-eating profit isn't just terrifying EV investors. It is the exact same underlying fear that is suddenly gripping the tech sector.
Oh, without a doubt.
While automakers are struggling with the physical cost of moving metal, big tech is dealing with the immense, margin-crushing physical cost of building the digital future.
The capital required to build the infrastructure for the next decade of technology is genuinely staggering, and we are seeing that tension play out on the balance sheets today.
I saw Microsoft stock jumping today, and they were one of the most active stocks on the board. Our briefing points out they just committed $2.5 billion and 6,000 employees to a brand new AI implementation unit.
Just wrap your head around that scale, 6,000 people.
That is the population of a small town, dedicated entirely to figuring out how to actually apply AI. But if Wall Street is terrified of companies burning cash, why is the market rewarding Microsoft for spending billions while punishing automakers for margin compression.
Because Microsoft is offering clarity of execution. By dedicating 6,000 employees to an implementation unit, they are telling the market, hey, we are done just researching AI in a lab. We are institutionalizing it into tangible enterprise products that we can sell tomorrow.
So investors reward that specific revenue-generating foresight.
Yes, but you cannot look at Microsoft's success in a vacuum. You really have to balance it against the warning signs flashing across the rest of big tech.
Like Meta. Our sources specifically highlight that Meta is pushing incredibly hard into cloud computing right now. But there's a massive red flag attached to that expansion. It threatens to lead to lower operating margins.
People often think of the cloud as this magical, invisible network floating in the air. In reality, the cloud is incredibly physical.
Right. It consists of massive, sprawling server farms stretching across acres of land.
Exactly. It requires a staggering amount of raw electricity to power and millions of gallons of water or advanced HVAC systems to cool. Meta is being forced to invest heavily in this physical infrastructure just to stay relevant in the AI arms race.
But those investments are incredibly capital-intensive, and they are eating into the core profitability of their software business.
Precisely.
Which brings us to Apple. Apple was a top gainer today, up 4%, and again, highly active. You would think in 2026 their stock bump would be all about some new AI integration, but our sources note their demand recovery is actually looking stronger than its AI narrative right now.
Which is really surprising.
Yeah. And it's being spurred by reports of expanded foldable iPhone production. Consumers still really care about cool physical hardware.
Physical hardware has always been the irreplaceable engine of Apple's revenue. But the cost of producing that hardware in today's macroeconomic climate is exactly what threatens this broader tech rally.
The briefing specifically points out that Apple is facing dual margin pressures. They are getting squeezed from two distinct sides: international tariff costs and rising raw component expenses.
It's a tough spot to be in.
It made me think of this analogy. It's like a famous real estate developer building a state-of-the-art, futuristic luxury high-rise. The architectural blueprints are amazing. The wealthy buyers are lining up around the block to put down deposits.
But suddenly the price of steel and lumber has quadrupled.
Right, and the city just doubled the property taxes on the land. At a certain point, the developer is losing money on every condo they sell. How sustainable is this tech rally if the raw materials required to build this digital future are just eating all the actual profits?
You've identified the central tug-of-war happening across global markets right now. Tech companies face an existential ultimatum. They absolutely must build the massive AI server farms and manufacture the cutting-edge foldable hardware. If they stop innovating, they die.
But on the other side of the rope, they are constrained by the gritty, unglamorous reality of the global supply chain.
Exactly. Tariffs, the cost of silicon, the price of energy on the electrical grid. The market is currently trying to decide which companies can absorb those massive physical costs and which ones will see their profit margins crushed by them.
And if the tech giants are getting squeezed by the physical costs of innovation, and the EV sector is struggling to find willing buyers in a shrinking labor market, that investment capital has to flow somewhere. Wall Street hates letting cash just sit still.
Capital is like water. It always seeks the path of least resistance toward a reliable return. And right now, it is flowing away from digital promises and pouring into tangible realities.
Our briefing today reveals three shockingly different sectors that are defying all of this economic gravity we've been discussing. Let's start with semiconductors. The briefing notes there was a broader semiconductor sell-off today as investors worried about consumer electronics.
But within that, one specific subsector is absolutely on fire: memory chips.
Yeah, the memory rally remains completely intact. Our sources point to Micron technology to exemplify the underlying strength of the memory sector as a whole, even though, ironically, Micron specifically took a 5.8% hit today and was a top loser due to some short-term trading noise.
Right, but the trend is clear.
Why is the memory sector so incredibly resilient when the rest of the chip market is taking a breather?
Forget the old cliche about selling picks and shovels during a gold rush. Think of memory chips as the concrete highway infrastructure of the artificial intelligence revolution.
Okay, I like that.
You can design the most advanced million-horsepower AI processor in the world. But that processor is completely useless if the memory highway it uses to access data is only a one-lane dirt road.
Because AI models require moving unfathomable amounts of data instantaneously.
Exactly. So while investors might panic about the chips used in consumer laptops or electric vehicles, they know that the demand for high-speed memory is structurally locked in by the global AI arms race.
The highway has to be built, regardless of who is driving on it. That makes so much sense. Okay, let's pivot to the second hidden pocket of massive growth. And this is a jaw-dropping number. Autonomous drone startup Quantum Systems just raised a staggering $1.2 billion.
Billion with a B for a startup.
It is a monumental injection of capital.
And it signals a massive paradigm shift in venture capital strategy.
It feels like we were watching a modern space race, but purely for defense tech. With the macroeconomic picture feeling so shaky, the shrinking labor force, the nervous car buyers, the tech margin squeezes, it seems like defense is rapidly becoming the new safe frontier for tech investors.
When everyday consumers stop spending, you pivot and sell to the Pentagon.
Exactly.
Investors are aggressively piling into defense tech because sovereign defense budgets operate completely outside of the normal macroeconomic cycle. The government's military budget is not dependent on consumer confidence. It doesn't care about the labor force participation rate.
And it certainly isn't worried about EV margin compression.
Right. In a world defined by digital uncertainty and consumer anxiety, government defense contracts offer a rock-solid, inflation-resistant revenue stream.
Which brings me to the absolute most surprising trend from our sources today. We've talked about the cutting edge of AI, we've talked about autonomous defense drones, but our briefing highlights another sector pulling in massive institutional capital: gas stations.
The quiet explosion of mega retail in the physical world.
Specifically, chains led by Buc-ee's. The briefing notes that these physical locations are expanding so massively across the country that they are coming close to rivaling America's traditional big box stores in sheer size.
They're massive.
We are talking about hundreds of gas pumps, immense retail footprints, and thousands of square feet dedicated to brisket and consumer goods. I need you to tie this together for me. How do memory chips, military defense drones, and massive Texas gas stations all make sense as the winners on the exact same market day?
Well, if you step back, they share one vital underlying characteristic that explains this entire bizarre day on Wall Street.
What's that?
Whether it is the physical memory chips required to make the invisible cloud function, the tangible drones built for geopolitical defense, or these colossal gas stations catering to the everyday physical needs of the American driver.
Wait, tangible physical world assets with predictable cash flows are attracting the smart money.
So while retail investors are obsessing over software valuations and virtual reality, the institutional capital is quietly hedging its bets by pouring into things you can actually touch.
Exactly. Amidst all this digital uncertainty, capital is seeking out the physical economy. A massive retail footprint sitting by a major interstate generates immediate, tangible cash flow every single day. And a drone is a physical product solving a real-world governmental problem.
Investors are looking at a shrinking workforce and margin-squeezed tech giants, and they are retreating to the safety of the physical world.
Man, we have covered an incredible amount of ground today. We started by diagnosing a severe structural crack in the economy, with workforce participation shrinking to a 50-year low and causing major macroeconomic anxiety.
Which is really the driver for everything else.
Yeah. We mapped how that consumer anxiety translated directly into bizarre market punishments, like Tesla dropping 7% due to margin compression, despite hitting their delivery targets. We dissected the multi-billion-dollar bets big tech is making on AI, and the physical reality of the cloud that is threatening to crush their profit margins.
And finally, we uncovered how billions of dollars are seeking a safe haven in the physical world, from the infrastructure of memory chips to defense drones and mega gas stations. Today is a masterclass in why you have to look beneath the surface of the headlines. In a market defined by deep economic uncertainty and incredibly expensive technological shifts, the traditional rules of investing are being rewritten in real time. You just cannot understand a stock's movement without understanding the macroeconomic engine driving the consumer.
And that leaves us with a genuinely fascinating thought to walk away with today. Building on everything we've pulled from our sources, think about the premium suddenly being placed on the physical world. Apple is seeing its biggest demand surges, not from a software update, but by leaning heavily into complex physical, foldable hardware.
It's all about the physical stuff right now.
Yeah, retailers like Buc-ee's are dominating immense plots of land and functioning like megastores. AI companies are desperately scrambling to build physical server farms and secure power grids. So here's a question for you to mull over as you go about your day. In an era that is completely obsessed with artificial intelligence and the cloud, will the next decade of market dominance actually belong to the companies that master physical space?
It is definitely the defining question for the next generation of investors.
That's all for today's deep dive on Tech Money Madness. Don't forget to like, subscribe, and we'll see you tomorrow for more market coverage. Keep questioning those headlines, keep looking for the hidden mechanics behind the data, and we will catch you on the next one.